Welcome to Wealth Talks, where we talk about solutions, money, and other things in your life. And like she said, Michelle is back with us today, John. So we're going to be talking about investments because personally, that is what I see most people wanting to talk about when they call our office. They're wanting to know how life insurance purchase would compare to an investment that they're thinking about.
Well, now, wait a minute. I thought we were talking about investing today because I said I wanted to talk about if I came on the show today.
Well,
and now I find out that it's something else. No, but Tom's right. A lot of people want to invest. In fact, they kind of get things turned around. There's 4 steps to building a stable financial
future
life.
Yes.
And investing is at the bottom of that. The people forget to start at the beginning, which is to protect your family. So life insurance is great about protecting your family. Then to save money so that you can eliminate debt, produce more liquidity. And then finally we get to investing. But
yes.
That's where people want to start. In the last show, we talked about all 4 of those steps. And as you announced, Tom, we are going to talk about investing today.
Well, back in the day, as they say, it used to be very common for people to buy a house and buy life insurance at the same time.
Yeah.
We've talked to many clients who actually borrowed from their life insurance policy to pay their house off after there was enough equity built up in the life insurance policy.
So do you recommend that today, Tom?
I think it's absolutely important that people have protection on their mortgage, on their life. Because if I was to die today and leave you a mortgage payment, that would be a double pain. I would be gone out of your life, but I'd have left you a financial burden as well.
Yes.
Because there is no way that you would be able to comfortably and easily continue to pay the mortgage payments, or you would be forced to have a fire sale to get rid of the house as you pared down to live in a smaller place. Mm-hmm. And so it's only out of consideration to the people that you love that you're going to buy that life insurance policy. That's the protection we're looking at. Yeah. We're protecting my income. Mm-hmm. Like we said in an earlier podcast, we are buying money for the future when I can't be there.
Yeah. So what about borrowing then from the policy to pay off the house? Is that something that we do in today's environment?
Well, it may not be something that we do today, but there may come a time when interest rates are so high again. Like when I got out of school, it was wonderful to get a 17% arm loan for a house, and people were excited about that because prime was 21%. So if those conditions happen again, which is altogether possible because we're not on a gold standard anymore, then yes, it would be ideal to borrow from the life insurance policy to pay the house off.
So the interest rates on the life insurance are usually a lot lower. Like back in the time we were talking about, they were only 8 to 11%. Quite a far cry below the 17.
And some of the people that we talked to, it was back when real estate really had a value too. The inflation has destroyed the value of real estate over a long period of time because the taxes have gone up on the property, and by the time you consider all the interest you've paid on a 30-year mortgage, when you factor it out, the profit margins are pretty slim sometimes.
So my takeaway from this conversation so far is that there's not just one answer, yes or no.
That's correct.
We've got to consider the environment and what's happening and think about it.
Yeah, and we know we want the protection.
Yes.
And we know we want to save. Life insurance is a great vehicle to do that in
and
conjunction
then we
with
have
the
options.
house purchase.
Then we have options about what to do when the time comes.
So do I recommend buying insurance on your life when you buy a house? Absolutely.
Yes.
Because then every payment that you make into the insurance in the house acts as savings for you. And that then can be used to help consolidate debt or to produce liquidity that you can pay off debt very easily with, or to purchase some other asset that's going to generate a passive income for you.
Yeah. Mm-hmm. So I hear you saying that, making a payment on the house is acting like a principal payment. Some people do see their house as their investment. In fact, they want to get that house paid off because they see that they're getting rid of a liability and they see the house as an asset. So I know we've talked about this in some ways before, but is that really where somebody wants to put all of their savings in their house?
Let me approach that in 2 different ways. Let me start with a story of a client of ours who had their house paid off, whose husband then had a heart attack when they didn't have health insurance because he was He was not an American national. They had no health insurance on him. They thought that they could go and just get a home equity line of credit against their home and pay for his hospital bills. The bank said, forget it. You don't have an income that will allow us to justify giving this loan. So their asset, their home, was actually a liability to them because they could not get the money out of it when they needed it. The second story is a personal one. When we moved to Virginia, we paid our house off. I wrote a check for it and thought, I've won this game. I got rid of the house payment. But guess what? The next couple of years were a struggle for us because my business didn't start and grow like I expected it to. And so there were many times I wished I could have reached into the walls of my house to get that money out that I had put into it. The banks wouldn't look at me because my income wasn't there. And we struggled, didn't we, Michelle?
Yep, we did. And now look, we get to tell this story. Something good came out of it.
Yes.
But yeah, that was a hard time.
It was
a lot
tough
of pressure.
times. And so is your house an asset? It's an asset emotionally, maybe, more than it is actually monetarily, because it's not a liquid asset. And that's what everyone wants at number 3 of this game, is they want liquidity. And real estate is not a liquid asset. You've got to get the money out by selling it or going to a bank and proving that you can pay the loan back. Mm-hmm. And that sometimes is more difficultly done than just saying that it needs to be done.
Well, and yeah, because you could have a house that's worth a certain amount, but in the current economy, it may not be worth that much. And so you either sell at a loss or you wait until time changes, and we don't know how long that's going to be. So that it's not a real liquid asset for what you put in is what you get out, or appreciation or whatever. We can never just easily govern that. That's
And we always think our house is worth more than it should be because it's our emotional attachment to it.
Oh, sure.
You know, I just saw the other day that Taylor Swift took $35 million off her mansion in California to sell it because it's not going. Nobody else thinks it's worth what she thought it was. Otherwise, she wouldn't have listed it that. But the thing is the market, whatever everybody else thinks your house is worth is what it's going to sell for.
Right.
And so
that kind of covers, somebody's mortgage, their home, as an investment. Before we move on from that, I just want to invite our listeners here to write in to us about how you've thought about mortgages in the past. You can write into us, team@life-benefits.com. We'd love to hear your thoughts on this.
And it might not even be what you've thought about in the past. Maybe it's what you're thinking about right now, and you want us to kind of listen to you on this and see if we have another perspective to add to the mix there.
And if you're not in front of your computer, just send us a text at 702-660-7000 and pop your question to us that way, because we're here. We want to answer your question and address it. And, as we move through these types of things, we always have to realize the situation that everybody's in, okay? When we talk about our story in Virginia, when we paid cash for that house, we were starting a new business and everything, and times were tough because we didn't have an income that was coming in, okay? After we moved here, we went back and reevaluated some things and how we had purchased real estate in the past. And if we would have bought the life insurance, the protection process along with paying for our house, we would have had like over $750,000 more liquid dollars that we could have used from just the money that we paid into real estate over the years.
You made a video on that, and John, they can look that video up by going to our website.
Yes, search for Fun with Real Estate. You can look up that video and check it out. We'll also try to put the link in this podcast.
So Fun with Real Estate in the search bar of the website, life-benefits.com.
Which brings us to another story that I like to tell. I loved Mike Milligan and his steam shovel, Marianne, when I was a little boy. That was
Mike Milligan and Marianne.
That was one of my favorite stories. We read it a lot to you too as you were growing up.
Yes,
John.
I remember it quite well.
And so the story is that Mike Milligan has the steam shovel, and he loves
Named Marianne.
And he always digs better and faster when people watch him, although he never was quite able to prove that.
Well, he thought he could dig. Oh, you're missing part of it. He thought he could dig as much as 100.
100 men can dig in a week.
Okay, in just one day or something. But he had never been able to prove that. As long as people were watching him. In other words, he needed this crowd cheering him on,
Yes.
right?
And really, that comes down to the fact that we need to be accountable. And that's what we're here to be, is friendly, accountable people that you can sound things off of and talk to. We're here to watch over you as you're learning how to ride this bicycle so it doesn't crash and burn on you, because it's different than what everyone else is doing. And we want to be able to make sure that as we watch you, that you build the skills to protect, save, provide liquidity, and be able to go through those investment processes without losing money.
Mm-hmm. Good. So another thing to invest in, investing in ourselves and in what we know best. So, you think about a young person. Well, let's think about you with your, someone who has a young family. You invest in that family by providing opportunities for the children to do different things, experience different things. And really, that's an investment in your children. And then as children get older and graduate from school, they go to college oftentimes. And unfortunately, a lot of times that's done on somebody else's dime. And maybe that isn't the best investment they could make. Maybe they're not really going to get the kind of return on that. That's something to be thinking about as well. But you want to think about investing in your life to be more productive. Business owners invest in their business, buying a piece of equipment that they can use in their business to create a greater income for themselves. Think about what you already know, because if you don't know much about it, chances are you may not do very well in that investment.
Mm-hmm. Yeah, and so many people, when they hear the word investment, they automatically think stock market, maybe an index fund, a mutual fund, something like that, bonds maybe. They're thinking typically like the
something
big
on the
investors
outside, yeah.
portfolio. Yeah. And some people even think they're tax qualified plans, which they even confuse a little bit, the saving and investing aspects of those.
And what we need to realize too is that smart investors like Warren Buffett have said that we don't need to necessarily diversify our investments all over the place, because he said that that's only important for people who don't know what they're doing.
It drags down the return. Certainly.
And so, like what you were saying, Michelle, if you're a business owner, you already know more about that business than anybody else. That's where you should invest first.
You know what's needed, what equipment's needed, what advertisement's needed. You know what you can do to make things better.
And here's the key on that. If you need money for your business, you can go to a bank and maybe borrow it, or maybe to a third-party lender and get it. They're going to set up a repayment schedule. They're going to have a penalty probably for you if you pay it off early, because business loans are often set up that way. So you're going to be stuck paying interest and principal to them for the number of years that they require for that loan. Now, if you have started with the protect, save, liquidation, and investment procedures that we're recommending,
the 4 steps. Mm-hmm.
Then what's going to happen is you're going to have the liquidity inside the protection device, the life insurance policy that you can borrow from to invest in your business, and no one's going to give you a payment schedule. All that is going to have to happen is that you're going to have to pay the interest on that loan. So let's say that it might take you 6 years to pay off a business loan that you get from a third party, but you have 3 years of really tight cash flow because the investment in your business didn't produce the capital that you thought it was going to be. Could that stress your business?
Oh, yeah.
Certainly could.
Could stress me, the business owner.
Well, with the life insurance policy, you don't have to be stressed, because all you have to do is pay the interest, knowing that you can pay the principal back in later years, which you want to do. And even then, you continue to get to write the interest off on your taxes because it was a business expense.
So when one of our clients, especially a business owner, takes a loan, talks to us about it, then we'll help them set up documentation so that they have a repayment schedule. They can always change it a little bit if they need to,
yes.
But obviously we want to make sure that interest is being paid.
Yes.
For a business owner, you also want to have record of that interest, because of the tax deduction.
Yes.
Yeah.
If you have the documentation, that means you can claim the deduction on your taxes.
Now, we're often saying never take a policy loan that is where you can get money at a lower interest rate. But here on a business loan or an investment purpose, we might change that rule just a little bit.
Well, always
Because-
and never aren't always the best.
They're not always the
Aren't
best thing.
always the best words to use, right?
And the reason that we would change that is because on an investment or business loan, the interest is still deductible. And if we are not really, really super confident that the cash flow is going to come from that investment or business loan, then it might be better to borrow it from the policy than a third party who's going to demand both interest and principal back when maybe cash flow might be a little bit tight for us.
Well, when you play the role of being the investor and the one that's invested with, you're holding the strings there. You've got all the control, so you can alter it if you need to,
Yes.
and it's perfectly legal. You just make an
And
alteration.
the clients that we're working with, we mentioned earlier that most people, when they think about investments, think stock market or
Yeah,
some
yeah.
real estate, things like that. Most of the clients that we work with, the ones that are successfully taking policy loans are putting it into their business. Some of them do have a business in real estate. They
Yes.
put it in there and they do very well. Some of them do put it in the stock market. They have a business that relates to that. They do well with it.
Yes.
Generally, those are the people that we see doing the best with the money that they're investing in those traditional ways.
Right.
Well, Michelle, something you just said reminded me of one of the first CPAs that we went to talk to about this concept to see if it was above board and audit proof and all that.
Yes.
And he said, anytime you have a share in the entity that you're borrowing and paying interest to, you're going to come out ahead.
Mm-hmm.
And that's what the life insurance is. We have a mutual interest in that company by being a policyholder. And now when we borrow from it and pay back interest, it only can improve our situation.
Okay, so now I know some of our listeners out there, in fact, many of our listeners are not business owners. So what you need to do is just go ahead and get yourself a new cap and put it on, because as you handle your money, you are a money manager, and you can consider yourself as in the business of handling your money.
Oh, absolutely.
And so don't feel like you're left out here. And someday you may even start a little business that manages money in some way. And then you'll be able to take advantage of some of those tax deductions we're talking about. But please don't think that just because you're a W-2 employee or maybe you're retired, don't think that this doesn't apply to you, because you have the ability to put on your hat as a money manager and handle this as a business. So don't think that doesn't apply to you. As far as the tax deductions, though, there are some extra benefits by being a business owner. So maybe that will be in your future someday, but don't worry about it. Let it just happen naturally.
It's all about being a better money manager.
Yeah.
America today are losing, at least 9% of every dollar they spend on interest. And they're just losing a whole lot more of that on taxes, local, state, sales tax and whatnot.
Fees. You just wrote an article about fees that banks collect. I think that was from last week. That's amazing.
It's astronomical what they're collecting. And not only up front, like through ATM fees or late check fees and account fees and lines of credit fees, but the fact that they're being bailed out at about $16.8 billion by our tax dollars as well. And so the thing is we can avoid those bank fees, whether you're a W-2 owner or whether you're a business owner or an investor, by using the life insurance policy as the way that we're recommending. And that's why we do it, and that's why we're so sold on it.
Mm-hmm. So something else I want to say about investing, something else that happens when, John, like you said, people are thinking big stock markets, mutual funds, whatever, is we have a lot of clients who have values that differ than what some of those stocks are invested in. So, for example, we do have a lot of clients who are chiropractors, And several of them have said to us, I don't want to invest in the stock market because a lot of them are connected to the pharmaceutical companies. And how can I be in my office telling people, I got to get you off these drugs so that you have better quality of life and you can do this, while they're really hoping that their money is doing well invested in the pharmaceutical companies. There is a conflict there. And besides pharmaceutical companies, I mean, I think that anyone who has principle and has values can think of a number of different things that are out there that they don't really want their money invested in. So do we really want to say, do you want to be praying and asking for a better society, and yet at the same time rejoicing that these companies that are promoting the negative society are doing well and your money is growing?
Yeah. There's a whole movement around that. It's called values-based investing.
Yes.
Okay.
But still, those investors are often looking to the stock market, trying to balance and manage this risk. It can really become a full-time position for somebody who's really going to understand what they're doing.
Right.
And, for those of us who don't want to spend a full-time position finding out what the market's going to do and speculating, basically, much of the time on what the market's going to do, we can start with a guaranteed foundation and make the whole process more secure.
And that's something that's real important for everyone to realize, is that these mutual insurance companies that we are paying premiums to are taking our premiums and they are investing, but they're not investing in the stock market. They're investing in commercial bonds and in treasury bills and bonds that give yields for 30 or 40 years at a time. So many times we're reaping the rewards of an investment that was made sometimes even before our clients were born.
Oh, that's amazing.
And they do such a good job at it, they can give you a guaranteed rate of return, which is really not a rate of return at all. It's a mortality credit, because they know exactly the probability of who's going to die when. And so then based on that, if they do better with those than what they projected, they share those profits with us in the form of a dividend. And so we can get a figured annual comparative yield of about 7.2, 7.3% of someone in a tax equivalent investment.
Yeah.
So what I just heard you say, and where my thoughts went, were the insurance companies are investing in things that are very solid, over a long period of time, and they're being successful because the companies we represent are paying out dividends every single year. So that's something important for us to kind of take note of here. Listen up, folks. Look how these people are, this company's being successful. And how does that translate in our own life? First of all, we get to springboard off of their success. We get to be owners in the company when we have a policy. But then also, how do we manage our money? Mm-hmm. Are we doing it for the long term, like these insurance companies, being very stable? Or are we wanting the quick buck, or maybe the loss of a quick buck?
That's right. And I just want to jump in here too. The 7.2, 7.3% that you mentioned, that is what you would have to earn in the market before taxes, before fees, and all of that. That's really amazing, because if we look at the S&P 500 from 1926 through 2017, the real rate of return is only 6.71%.
Wow.
And so that's why so many of our clients that have had these policies 20, 30, 40, 50 years and coming to us and saying, this is the best investment I ever made, can really retrospectively say that with all confidence.
Yeah.
And
people say life insurance is a terrible investment. The truth is, it isn't an investment. But when you look at the long-term results like that, was it really a good investment?
No, you said that return was, what was it?
7.2, 7.3. I think if I'm remembering the exact number right, I think it was 7.32%. Based on a study that was done by one of the insurance companies, they think it was a tax bracket somewhere between 20 and 30%. And then a fees rate. I can't remember exactly.
And then you said the S&P actual return
The actual rate of return on the S&P 500 from 1926 2017, 91 years, was 6.71%.
Okay, so why then do we hear you can get a rate of return of 10, 12. Why do we hear that, John?
Because they're talking about the average rate of return, not the actual.
Different wording, huh?
The average rate of return on the S&P 500 over that same time period is almost 10%.
Wow.
But that's not what you're actually getting.
That's true.
So that's a little bit of sleight of hand there or something.
It is.
And
we have a video on this one as well. You can look it up on our website. Look up average rate of return versus actual rate of return. We'll try to put the link here in the podcast resources as well.
Okay. Wow.
So really, when people start talking about rates of return and average rates of return, whole life insurance doesn't have an average rate of return. We can just go back and figure what it would have been had it been a return on your investment.
Right.
Because we're really buying an asset. We're buying a death benefit. And that's why it's the only insurance product out there that we actually create equity with. And it's that equity then that we can leverage or surrender and get money and capital to do what we want to do with.
When we figure it based on policy values, it's called an internal rate of return because we're figuring it backwards based on what's been put in over the years and what we have now.
Mm-hmm.
That's called the internal rate of return. And even that's not the whole picture because that's after fees and after taxes. So when we look at it, that's going to be anywhere between 3 and 4% on most insurance policies that we look at. Varies based on age and health.
Mm-hmm.
The 7.32% is what the market equivalent return would be before fees, before taxes. So that has to be added onto it.
And of course, we always have to remember that 7.32% or whatever that the policy is doing that would be compared to a tax equivalent account. The tax equivalent account has no death benefit.
Death benefit's like a bonus.
It's like a bonus. So if we're talking about protection for, let's say in the future, Michelle, I pass first, I'm going to leave a death benefit to you. And with that death benefit, I can guarantee you will have an income for the rest of your life. And if you will take that death benefit and buy a joint annuity with our children, they will have a guaranteed income on their life for the rest of their life. There is no way that can be surpassed by an investment.
Yeah.
It's amazing. You try to figure the rate of return on that, it
becomes phenomenal.
Amazing.
Yeah.
Depends on when the person's going to die, which we don't know.
Uh-huh.
Yeah, but it is phenomenal.
So in that case, we don't want as high of a rate of return as we could have, right?
Exactly.
Because otherwise you'd have to pay your premium and die the next day and you'd get the best return.
Now we're coming to decisions that can't be made on a spreadsheet, right?
Exactly. Okay, so Tom, I heard you say something a moment ago. Whole life insurance is the only insurance that produces
equity.
Equity. There you go. That's the word you used. Now, and what I was thinking about while you were talking, John, is some of these insurance products out there. Universal life is tied to the market.
Yeah, it is.
Okay, so tell us about that.
Well, universal life, we have to go back even a little bit further than that. We talked about that a little bit on this podcast, but it's based on term insurance.
Oh, yeah. Mm-hmm.
And so you have the ever-increasing cost of insurance that's built into these universal life products. You also have the market risk and so many different things that the insurance company can change. We'll include a link where we've talked about universal life insurance on this podcast. We'll put it in the resources to this one. So those of you listening can go back and listen to that episode. But basically, you're just taking on a whole lot more risk that the insurance company with any universal life insurance product, whether it's variable universal life, plain universal life, or indexed universal life. You're just taking a whole lot more risk that the insurance company would take for you if you went with whole life.
Yeah, so we don't sell that stuff.
No.
But we do have a really good video on that. Gracine did a presentation at a former Wealth Summit. Do you remember what people could search for?
I do not. We'll try to pull the link along with the podcast into the resources.
And if you're just going to the website, life-benefits.com, put in the search bar maybe kinds of life insurance or
types of life insurance.
Yeah, and look for the video of Gracine at a Wealth Summit. And John will try to get that in there too.
Well, you guys, we're having a great time, and we've talked about a whole rampant of a whole bunch of stuff this time. But
it's related to investing.
But you know what? This podcast is about solutions, money, and other things that create wealth in your life. And oftentimes those other things aren't monetary.
True.
And so many times people will tell me they don't care about the death benefit. Well, that's one of those other things. Why are we doing what we do? We live this life not just for ourselves. We live it to make the world a better place. And whether we have a special loved one that we want to leave a legacy to, or we have a special charity or some endowment fund that we want to leave it to, we can continue to make the world a better place by leaving a legacy. And that's why, another reason, we use the life insurance. So until next time, when we're back here again talking about solutions money and other things that create wealth in your life, you have a great rest of your day. We'll be back here at the same time next week.